The data flashing across my screen tells a story that's both shocking and, for many, incredibly difficult to believe. Nevada's housing market, once a poster child for the pandemic-era boom, is now flashing warning signs that point toward a severe and potentially historic correction. You may have seen the apocalyptic headlines predicting a collapse 10 times worse than 2008. But as an independent analyst, my job isn't to peddle in fear, it's to follow the data. And the real story, uncovered by cross-referencing exclusive claims with hard numbers from the Federal Housing Finance Agency, FHFA, and Zillow Research, is far more nuanced, and in some ways, more concerning, than any sensational prediction. While a total Armageddon-style meltdown is highly unlikely, the convergence of risks facing Nevada is unprecedented. We're not just talking about high mortgage rates cooling off a hot market. We are looking at a perfect storm of demographic shifts, a precarious water security situation, and economic vulnerabilities that could trigger a decline far exceeding the national average. The core issue, as highlighted by NAR's latest affordability index, is a fundamental disconnect. Home prices in Nevada skyrocketed on the back of remote work and migration trends, but local incomes simply did not keep pace. This has created a market built on a fragile foundation, one that is now being tested. In this analysis, we will move beyond the hype. Using data visualizations from the top real estate analytics firms, we will break down the 5 critical forces converging on the Nevada market, explain what this means for your home's value, and separate the real, actionable risks from the sheer speculation. Let's dive in. The water crisis. Is it really a ticking time bomb? The images are stark and undeniable. Bathtub rings etched into the cliffs around Lake Mead, a visceral monument to a 2-decade-long megadrought in the Colorado River Basin. This is the foundation for one of the most alarming narratives about Nevada's future, that a water apocalypse is imminent and will single-handedly evaporate property values. The core facts are true. Lake Mead has indeed hit historic lows, and the Bureau of Reclamation's models have outlined scenarios that could force severe water cuts for Nevada, potentially up to a daunting 35% in a worst-case scenario. This is a serious long-term challenge that the state must navigate. However, calling it a ticking time bomb set to detonate the housing market in 2026 is an oversimplification of a highly complex issue. The direct, immediate impact on home values is often misrepresented. To understand the real risk, we need to separate the hydrological reality from the housing market mechanics. Data from Zillow Research provides crucial context. Their analysts consistently find that short-term housing market dynamics are overwhelmingly driven by immediate economic factors, employment rates, wage growth, and most critically, mortgage affordability. A household's ability to qualify for a loan at today's interest rates has a far more immediate and powerful impact on their decision to buy a home than a projected water shortage several years out. People need jobs and paychecks to pay mortgages, first and foremost. This isn't to say water risk is irrelevant. Zillow's own research into climate risk acknowledges that long-term environmental factors, including water scarcity, are increasingly being priced in by the market. This means that over time, perceptions of risk can gradually affect buyer demand and, consequently, values. But this is a slow, gradual process, not a sudden cliff that the market will fall off on a specific date. Furthermore, the Bureau of Reclamation's internal projections are part of a complex, ongoing negotiation process among the 7 Colorado River Basin states. The 35% figure represents a severe Tier 3 shortage scenario, a possibility that is motivating these urgent negotiations. It is not a predetermined outcome. The historical precedent shows that states have consistently come together to agree on mitigation plans, such as the 2023 agreement where states, including Nevada, agreed to voluntary cuts to protect reservoir levels. So, what does this mean for a homeowner or potential buyer? The water crisis is better understood as a chronic condition requiring management, not an acute terminal event. The Southern Nevada Water Authority has been a global leader in water conservation for decades. Through investments in massive recycling programs, returning treated water to Lake Mead, and aggressive removal of water-intensive turfgrass, the community has drastically reduced its water consumption per capita. This institutional preparedness acts as a buffer against the most drastic scenarios. The bottom line, While the water situation is a critical long-term challenge for Nevada, it is unlikely to be the sole trigger for a housing market collapse. A sudden 60% overnight drop in value, as some fear, would be driven by a catastrophic, immediate event, like a total cutoff of water, which is not in the projections. The real, immediate risks to the market remain the fundamentals: what happens with jobs, inflation, and interest rates. The water crisis adds a layer of long-term risk and uncertainty, but it is being actively managed and is just one piece of a much larger puzzle. Investors should be aware of it, but they should panic over affordability and demand, not a single drop of water. The labor market, the overlooked keystone. Amidst the alarming headlines about water crises and corporate exodus, a more fundamental and immediate threat to Nevada's housing market is being dangerously overlooked: the structural weakness of its labor market. While the official unemployment rate, U3, from the U.S. Bureau of Labor Statistics, BLS, tells a story of a recovering economy, a deeper dive into the data reveals a precarious foundation that cannot support the weight of current home prices. The real story isn't just about how many people are out of work. It's about the crippling disconnect between the jobs they have and the homes they want to buy. Let's address the headline number first. The claim of an 11.7% real unemployment rate is unverified and likely incorporates broader, more subjective measures of labor underutilization, known as U6. However, the official BLS data is concerning enough. For much of 2023, Nevada's unemployment rate consistently ranked among the highest in the nation, hovering around 5.4% compared to a national average near 3.7%. This high rate is a legacy of Nevada's economic model, which is heavily dependent on the tourism and hospitality sectors, industries notoriously vulnerable to economic downturns. This inherent volatility in employment creates a layer of financial insecurity that makes committing to a massive mortgage a risky proposition for many families. But the true Achilles heel of the housing market, as highlighted by the Redfin data center, is not unemployment, it's affordability. This is the critical factor that has been completely severed from reality. During the pandemic boom, fueled by remote workers and investors, home prices in Nevada skyrocketed by over 80% in some areas. Meanwhile, according to BLS wage data, median household income in Nevada grew at a sluggish, single-digit pace. This has created a devastating gap. Redfin's analysis quantifies this crisis. They calculate the monthly mortgage payment on a typical Nevada home at today's interest rates and compare it to the median household income. The result is an affordability ratio that has reached historic, unsustainable levels. To afford the median-priced home in the Las Vegas metro area, a household now needs an income of over $100,000. The problem? The actual median household income in the state is significantly lower, sitting closer to $65,000. This isn't a minor gap, it's a chasm. It means that the primary engine of any healthy housing market, the local first-time homebuyer, has been effectively priced out. You cannot have a sustainable housing market where the average local worker cannot afford the average home. This is where the decline of the gig economy, mentioned in the original content, becomes relevant. For many, driving for Uber or delivering for DoorDash was not a path to wealth. It was a survival tactic to bridge the income gap. As earnings from these platforms decline, that fragile financial bridge is crumbling, removing what little purchasing power remained for a segment of potential buyers. The conclusion is inescapable. The demand that fueled the boom was largely external: investors and higher-earning migrants. As that demand wanes, the local market is being exposed for what it is: fundamentally weak. There are simply not enough local buyers with sufficient income to support current price levels. The labor market's failure to generate high-paying jobs that keep pace with housing costs is the single greatest threat to the market's stability. While water shortages and corporate relocations are real concerns, they are secondary actors in this play. The main event is a simple, brutal equation of math. Incomes are too low, and houses are too expensive. Until that core imbalance is corrected through a significant adjustment in prices, a rise in wages, or a combination of both, the Nevada housing market will remain on shaky ground. The California revenge migration. Is the reversal real? The narrative of a California exodus has been a fundamental pillar supporting Nevada's housing boom. The story was simple. Californians, flush with equity from selling high-priced homes, would move to Nevada, pay in cash, and drive up property values for everyone. Now, a new, more sinister story is emerging: the revenge migration. This theory suggests California is actively luring people back, crippling Nevada's demand and triggering a collapse. But what does the data actually say? The reality is less about revenge and more about a critical cooling of the single most important source of demand for Nevada homes. Data from the National Association of Realtors, NAR, confirms the foundational truth. For years, Nevada has been a net beneficiary of migration from California. This inflow was a primary driver of population growth and housing demand. However, the most recent NAR migration analysis shows a crucial nuance. The wave, while still flowing, is decelerating. The rate of inbound moves from California is slowing down significantly. This is not yet a net outflow, but the weakening of this key demand source is a massive red flag for a market that became dependent on it. The driving forces behind this migration are economic, not emotional. Zillow's extensive analysis of migration patterns consistently identifies two primary factors: the massive home price disparity between the two states and the rise of remote work. For years, a tech worker in Silicon Valley could sell a $1.3 million bungalow, buy a mansion in Henderson for $600,000, and pocket the difference, all while keeping their high salary. This created a wealth transfer event that powered Nevada's market. Now, both pillars are shaking. First, the home price disparity is narrowing. As home values in California have corrected from their peaks and Nevada's have held relatively firm, the financial incentive to move has diminished. The payoff isn't as life-changing as it was in 2021. Second, and perhaps more critically, the remote work revolution is facing a counter-revolution. Major companies like Google, Salesforce, and Oracle have walked back fully remote policies, issuing return-to-office mandates. For the thousands of workers who moved to Nevada assuming a permanent remote setup, this is a devastating ultimatum: return to California or lose your job. This is where policy plays a role. California's approach to remote workers employed by in-state companies but living elsewhere creates a tax headache that effectively penalizes the arrangement. This administrative friction makes companies less likely to support out-of-state remote work, further cementing the return-to-office push. The impact is already visible in the data. While a mass panic-driven exodus isn't happening, there is a measurable uptick in movement back to California, particularly among those who moved most recently and have less equity built up in their Nevada homes. They are not revenge movers. They are often reluctant returnees facing an impossible choice between their career and their new lifestyle. The bottom line for Nevada's housing market is severe. The state does not have a deep enough pool of local buyers with sufficient income to replace the demand once generated by affluent Californians. A slowdown in this inbound migration is enough to cause a major problem. A stabilization or slight reversal could be catastrophic. The pipeline of equity-rich buyers that fueled the boom is constricting. Without that constant influx of external capital and demand, the market's foundation reveals itself to be hollow, unable to sustain its inflated values based on local economics alone. The revenge migration might be an exaggerated term, but the cooling of the California feeder system is a very real and potent threat that could tip the entire market into a significant correction. The mortgage bubble. Is history repeating itself? The ghost of 2008 looms large over any discussion of a housing market correction. The mere mention of subprime loans, liar loans, and foreclosure crisis is enough to send a shiver down the spine of any homeowner or investor. The original content raises the alarm about a high percentage of non-QM, non-qualified mortgage, loans and rampant HELOC, home equity line of credit, usage, drawing direct parallels to the past. But is this a case of history repeating itself, or are we facing a different kind of risk altogether? The data suggests that while the overall system is far more secure, a specific and serious vulnerability has emerged. First, it is crucial to acknowledge the facts that fuel the concern. The FHFA House Price Index, HPI, confirms that home prices in Nevada experienced a meteoric and likely unsustainable rise, increasing by over 80% from Q1 2020 to the market's peak. This kind of explosive appreciation often breeds speculation and risky financial behavior. Furthermore, the proliferation of non-QM loans is a reality. These loans, which do not meet the strict ability to repay rules set for qualified mortgages, cater to borrowers with non-traditional income sources or higher debt levels. They are inherently riskier than their qualified counterparts. However, this is where the comparison to 2008 largely ends. Research from the Urban Institute provides critical context that calms the fears of a system-wide meltdown. They consistently highlight that the overall mortgage landscape is fundamentally healthier today. Post-2008 regulations eliminated the most egregious lending practices, such as stated income, liar, loans, and negative amortization products. The average credit score of borrowers today is significantly higher than in the mid-2000s, and average loan-to-value, LTV, ratios at origination are more conservative. The vast majority of new mortgages are still fixed-rate, government-backed loans, not the adjustable-rate time bombs that exploded en masse in 2008. So, if it's not a repeat of the subprime crisis, what is the real risk? The danger lies not in the origination of the loans, but in the collision of high leverage and falling prices. This is where HELOCs and cash-out refinances come into play. During the boom, homeowners saw their equity skyrocket on paper. Many tapped into this wealth through HELOCs, using their homes as ATMs to fund renovations, pay off other debt, or sustain their lifestyles. The problem arises now that the market is turning. According to the Urban Institute's analysis, a homeowner who bought at the peak with a small down payment and then extracted equity via a HELOC is exceptionally vulnerable. If prices correct by even 10 to 15%, that homeowner could quickly find themselves underwater, meaning they owe more on their mortgages than their home is worth. This creates a potent catalyst for a downward spiral. Underwater homeowners have no equity to cushion a fall. If they face a financial shock, job loss, a mandatory return-to-office order, or a sharp rise in payments, they cannot sell their home without bringing a check to the closing table. This dramatically increases the probability of strategic default or foreclosure. When these distressed properties hit the market, they sell at a discount, compressing comparable sales prices and pushing more neighboring homeowners toward negative equity. The elevated level of non-QM loans amplifies this risk. These borrowers often have fewer financial buffers to withstand economic hardship. A wave of job losses, as forecast in other sections, would hit this segment of the market hardest and fastest, potentially triggering a disproportionate number of defaults. In conclusion, the mortgage market is not a carbon copy of 2008. The system is not riddled with fraudulent, doomed-to-fail products from day one. Instead, the threat is more nuanced, a concentration of highly leveraged homeowners who are uniquely exposed to a downturn. The bubble isn't in the quality of the loans themselves, but in the assumption of perpetual price appreciation that justified tapping so much equity. As that assumption unravels, the resulting equity destruction could force a wave of distressed sales, creating a feedback loop that accelerates the market's correction. It's not a subprime crisis, but a crisis of leverage, and for those affected, the outcome will feel just the same. The 2026 convergence. What is a realistic scenario? The year 2026 has been presented as an apocalyptic trigger point, a moment when multiple doomsday clocks synchronize to unleash a housing market collapse of historic proportions. While the concept of a convergence of risk factors is valid, the narrative requires a significant recalibration towards realism. Instead of a catastrophic event, data from leading institutions points to 2026 as a potential inflection point for a significant market correction, a painful but necessary rebalancing that falls well short of a 2008-style meltdown. The original content is correct in identifying that several economic cycles and policy deadlines are set to align around the 2025 to 2026 timeframe. However, the impact of this alignment is best understood through the lens of cold, hard data rather than alarmist speculation. 1. The residential market. A correction, not a collapse. The National Association of Realtors, NAR, provides the most grounded outlook for the residential sector. Their forecasts consistently point towards national price stabilization or modest declines, not a freefall. For a market like Nevada that overshot fundamentals more than most, this translates to a more pronounced correction. The The core issue remains affordability. The NAR's affordability index clearly shows that a correction of 10 to 20% is necessary to realign home prices with local income levels. This is not a collapse. It is the market's mechanism for healing itself and restoring accessibility for local buyers. The process will be characterized by extended time on market and increased seller concessions rather than a panic-driven crash. 2. The commercial wildcard. This is where a significant, underappreciated risk lies. Analysis from CoStar, the leading commercial real estate analytics firm, highlights a looming crisis in the office sector. A wave of commercial mortgage refinancing is due in 2025 to 2026. Many office buildings, whose values have plummeted due to the shift to remote work, will be refinanced at significantly higher interest rates and lower valuations. This could lead to defaults, bank stress, and a contraction in credit availability. While not directly impacting home prices, a commercial real estate downturn can trigger job losses in construction, property management, and professional services, indirectly weakening housing demand and exacerbating the residential correction. 3. The interest rate safety net. A critical difference between 2026 and 2008 is the structure of mortgage debt. Data from Freddie Mac shows that adjustable-rate mortgages, ARMs, which were a primary trigger of the last crisis, constitute a much smaller portion of the current market. The vast majority of homeowners today have locked-in fixed-rate mortgages, insulating them from payment shock when the Federal Reserve eventually cuts rates. This is a fundamental stabilizing factor that the doom and gloom narratives ignore. While high rates have crushed affordability for new buyers, they have also created stability for existing owners, preventing a wave of forced selling due to spiking monthly payments. The realistic 2026 scenario, a perfect storm of headwinds. Therefore, a more plausible scenario for 2026 is not a single explosive event, but a period of sustained pressure from multiple headwinds. Affordability pressure, the primary driver, as high mortgage prices continue to sideline buyers. Economic cooling, potential job losses stemming from automation, as mentioned previously, and any ripple effects from commercial real estate troubles. Migratory shift, a continued cooling of the inbound migration wave from California. Psychological shift, a change in buyer sentiment from FOMO, fear of missing out, to FONGO, fear of not getting out. This convergence will likely prevent any hope of a quick market rebound and will instead cement a buyer's market. Prices will grind lower as motivated sellers compete for a smaller pool of qualified buyers. This is a slow-moving correction based on economic fundamentals, not a sudden collapse based on panic. In conclusion, while the concentration of challenges around 2026 presents a clear downside risk, the tools for a complete systemic failure are absent. The market is built on a more solid foundation than in 2008. The most rational expectation, supported by data from NAR, Freddie Mac, and CoStar, is a tough correction that brings prices back to earth, a necessary and inevitable phase that will ultimately create a healthier, more sustainable market for Nevada in the long run. The goal for stakeholders is not to panic, but to prepare for a prolonged period of market rebalancing. Conclusion and personal perspective. After a thorough analysis of the data from credible sources like the FHFA, NAR, and Zillow Research, a clear picture emerges. The evidence does not support a forecast of a full-blown, 2008-style financial crisis for Nevada. The narrative of an inevitable collapse is a gross oversimplification of a far more complex economic environment. Instead, Nevada is facing the strong likelihood of a significant market correction. This correction is not driven by a single monster lurking in the shadows, but by a confluence of fundamental factors: a severe disconnect between home prices and local incomes, persistently high mortgage rates, and a concerning deceleration of the inbound migration that once fueled its boom. This recalibration will be painful for many, but it is a necessary and healthy process for the long-term stability of the state's housing market. Markets cannot indefinitely operate on external demand and speculation. They must eventually realign with local economic realities. This period of adjustment will ultimately restore affordability and create a more sustainable foundation for future growth. My actionable advice. For buyers, practice extreme patience. The power dynamics are shifting in your favor. Resist the urge to make a fear-based purchase, FOMO. Your greatest advantage right now is time. Wait for the market to show signs of stabilization, be prepared to negotiate aggressively on price, and do not waive crucial contingencies. Your goal is to secure a fair deal on a home you can truly afford, not to catch a falling knife. For sellers, radically adjust your price expectations. The peak prices of early 2022 are unlikely to return for many years. If your goal is to sell, your strategy must be to price competitively, even aggressively, from day one. The first few weeks on the market are critical. Overpricing your home will lead to it becoming stale, forcing you to chase the market down with subsequent price cuts. Attract the limited pool of serious buyers by meeting the market where it is, not where you wish it was. For investors, conduct a rigorous portfolio review. The era of easy, rapid appreciation is over. Shift your focus immediately from speculative capital gains to the fundamentals of cash flow. Stress test your investments. Can they withstand vacancies and a potential 10 to 20% drop in value? Ensure you have significant cash reserves to cover mortgages during a prolonged downturn. Prudence now will prevent forced, distressed sales later. The Nevada market is not a ticking time bomb. It is an overheated engine that is cooling down. This process will be challenging and will expose the excesses of the last boom. By focusing on core indicators from the FHFA, HPI, and NAR, not sensationalized headlines, you can make informed, rational decisions to navigate the coming period of volatility successfully.